Hello and welcome. Have you ever wondered if it's possible to get life insurance that protects you for your entire life, but without having to pay for it for your entire life? Well, that's exactly what we're diving into today. It's a pretty cool financial strategy that lets you lock in permanent coverage. And then, once it's all paid for, you can stop making those premium payments for good. So here's a quick look at our game plan. We'll start by talking about the problem of endless payments. Then I'll introduce you to the solution. We'll explore how it all works, compare the different ways you can set it up, figure out if it's the right fit for your life, and then, of course, talk about your next step. All right, let's jump right in. To really understand why the solution is so powerful, we first have to talk about the problem it solves. And it's a common anxiety, right? That feeling that some bills are just going to follow you forever. I mean, just imagine this. You've worked hard your whole life. You finally hit retirement. You're all set to relax, maybe do some traveling, and the last thing you want is another monthly bill hanging over your head, especially for something as critical as life insurance. This is a real concern for so many people planning out their future. Think about it this way. A mortgage, well, it has a finish line. You make that final payment, maybe pop a bottle of champagne, and it's gone. It's done. But what about our other bills? The utilities, subscriptions? They feel like they're just on a loop for the rest of our lives. So what if your life insurance premium could be more like that mortgage? Something you could actually pay off and be done with? Well, you probably guessed it. That exact concept does exist. It's the solution we're talking about today, and it's called limited pay life insurance. Okay, so here's the core idea. This is a type of permanent whole life insurance, but, and this is the big difference, instead of paying premiums forever, you basically compress all your payments into a shorter specific period. It could be, say, 10 years or maybe 20 years. And after you make that very last payment, the policy is what's called fully paid up. You never have to pay another dime, but that coverage, it lasts for the rest of your life. And the benefits here are pretty powerful. First off, and this is the big one, you get rid of premium payments in retirement. That's huge for your budget. You still get that guaranteed lifetime coverage, and the policy builds what's called cash value. Think of it kind of like a savings account that's built right into your policy, and it grows without you getting taxed on it every year. And down the road, you can even tap into that cash value as tax-free income. It just creates a really clear financial plan with a definite end date for those payments. So, how does this all work in practice? Let's take a look at the different payment timelines you can choose from, because this isn't a one-size-fits-all product. It's actually designed to be flexible to fit your specific goals. These are pretty much the most common options out there. A 7-pay plan, that's for someone who wants to get it paid off like yesterday, super aggressive. The 10-pay is really popular with professionals who are in their peak earning years. A 15-pay plan offers a nice balanced approach. And then you have the 20-pay plan, which has the most affordable annual payments of the bunch, since you're spreading the cost out over 2 decades. And this really highlights the fundamental trade-off, doesn't it? If you want to finish paying sooner, your annual premiums are just naturally going to be higher. You're essentially front-loading the cost to buy yourself decades of freedom from that payment later in life. It's a simple idea. Pay more now so you can pay absolutely nothing later. So how do these options really stack up against each other? And maybe more importantly, how do they compare to a traditional whole life policy? The kind where you just keep paying forever? Let's take a look. You can see a really clear pattern here. The shorter the payment period, like that 7-pay policy, the higher the premium is going to be. But the trade-off is that the cash value grows way faster. On the flip side, a 20-pay plan has much more manageable premiums, but that cash value is going to build up a little more gradually. This right here is the big picture choice. A limited pay policy is kind of like a rocket. You get this short, powerful burst of higher payments that supercharges the early cash value growth and gets you to the finish line fast. The traditional whole life policy, that's more like the tortoise. Slower, steadier, with lower annual payments, but you're committed to making them for your entire life, even deep into retirement. Okay, theory is great, but let's see how this actually plays out in the real world. We're going to walk through a quick little case study to see this whole thing in action. So, let's meet Sarah. She's 35 years old and she has a very clear goal. She wants permanent life insurance, but she absolutely, positively does not want to be paying for it when she's retired. She's looking at a $250,000 policy, and she's considering 2 options. With a 10-pay plan, sure, she'll have to pay higher premiums, but by the time she's 45, she is completely done paying. With the 20-pay plan, her premiums are lower, a bit more manageable month to month, but she'll be paying until she turns 55. And this is really the crucial point. The right choice for Sarah depends completely on her current financial situation. If she's in her peak earning years and she can comfortably afford those higher payments, the 10-pay plan is a fantastic option. It gets her to the finish line faster and builds her cash value more quickly. But if she wants a little more breathing room in her monthly budget, the 20 pays still gets her to her main goal of being done with payments well before retirement.
So, who is this strategy really best for? Well, it's excellent for high-income professionals who want to get those payments out of the way. It's great for pre-retirees looking to get rid of bills before they stop working. It can even be a great way for parents to set up a paid-up policy for their kids. On the other hand, if you're on a tight budget or your income is kind of unpredictable, those higher premiums could be a strain, and a different type of policy might be a better fit.
Okay, we've covered a lot of ground. So what's the one big idea you should walk away with? And what should you do if this all sounds pretty interesting to you? After everything we've looked at, it really all boils down to one powerful concept. You are buying yourself freedom. Freedom from a lifelong bill. And the freedom that comes with knowing you have a valuable, paid-for asset that protects your family and can grow for your future. The only question you really need to ask yourself is, does that kind of freedom align with your financial goals? If you think this strategy might be right for you, the best next step is to get some personalized advice. Here at the Annuity Expert, we can help you compare all the quotes and find the most cost-effective policy that fits your specific budget and your goals. And our services are always completely free to you. You can give us a call at 770-755-1565, or you can find us online at annuityexpertadvice.com. Thanks so much for watching.